Good morning. Pleasure to be with you all. We're here today to present our analysis of the current macroeconomic landscape and offer a data driven recommendation for monetary policy. We will provide an overview of economic conditions and offer forecasts for future growth along with potential risks. Based on this analysis, we will aim to balance the Federal Reserve's dual mandate of price stability and maximum employment.
Now let's begin with an assessment of economic conditions and outlook, focusing on the recent moderation in growth trends. Real GDP grew at annual rate of 1.4% in the first half of 2025, slightly below the estimates of long-run potential near 1.8%. The first quarter saw a contraction of 0.6%, followed by a strong rebound in the second quarter of 3.8%. The hot second quarter was driven by resilient consumer spending and one-time jump in imports, which boosted net exports. Still, recent data suggests that consumer spending growth is moderating, while business confidence remains constrained by trade uncertainty.
Thanks, Valeria. The dollar has remained strong throughout this recent cycle, though recent weakening as a result of trade policy comes with several implications. The dollar's sell-off supports growth via export competitiveness, but feeds into inflation through higher import prices, putting upwards pressure on inflation due to the United States' negative trade balance.
Turning to consumers, the personal savings rate has declined to 4.6% year over year in August, down from nearly 5% earlier this year. This signals that households have a smaller buffer against surprise shocks.
It is also important to note that consumer loan delinquencies has increased slightly. The research from Boston Fed highlights that this recent increase in delinquencies disproportionately have impacted those with lower income, while businesses and higher income individuals remains relatively stable. Overall, the consumer balance sheets remain relatively healthy, supporting continued strong spending.
Over in the bond market, in 2022, the yield curve inverted, followed by a normalization last year driven by rising real long-term yields. The nature of the normalization and the lack of a recession thus far support a soft landing narrative and indicate market confidence in the Fed's inflation targeting.
In 2025, Fed continued its quantitative tightening. The most visible adjustment has been its RRP facility. Use has fallen close to zero as liquidity migrated back into the banking system and bank reserves stabilized. Financial conditions are still adjusting, however, financial system is now well equipped with abundant amount of reserve to support lending.
Now we'll examine inflationary conditions within the macroeconomy, highlighting continuing trends and shifting pressures. Headline PCE is held steady at 2.7%, showing little movement toward or away the Federal Reserve's 2% target. Core PCE has shown a bit more firmness, edging up to 2.9%. This stickiness indicates that inflationary pressures, especially outside food and energy, are proving harder to bring down. Supercore PCE sits at 2.7% as well. This indicates that inflationary pressures persist in core goods and services.
During the pandemic, consumers shifted their spending away from goods and towards services. Now, spending has begun to rebalance, with moderate disinflation continuing in services. Food and energy contributions to PCE have declined dramatically, while housing remains a stable and positive contributor to overall inflation, signaling a shift in inflationary drivers.
Reflecting the shift, services spending remains a significant contributor to headline PCE, but now core good is exerting additional inflationary pressure on top of it.
Housing inflation slightly moderated, up only 3.9% year over year versus 2.7% for overall PCE, isn't a key component of core PCE. While this time last year saw housing play a significant role in inflation's persistence, core goods and services now appear to be more salient in the Fed's battle against inflation.
Inflation expectations have eased, with one-year expectations at 3.2%, near their lowest since the 2022 peak. After initial tariff-related concerns, expectations have settled near 3% and have stayed there since early 2024. 1- and 3-year readings are now close, reflecting a return to pre-pandemic levels.
Now, we'll discuss the state of the labor market, highlighting its resiliency in the face of higher rate and trade policy impact. Slower consumer spending in services sector is now driving businesses to hire more cautiously. Average job gain for last 4 months now sits shy of 27,000, much less than 2024 average of 168,000 jobs. Notably, 22,000 jobs were added this August, with the biggest driver being social services and healthcare sector. The federal sector saw a reduction of 15,000 jobs fueled by the widespread layoffs in the federal government.
And when considering the labor market, it is also important to note the large downward revisions of 911,000 jobs over the last 12 months. These revisions point to an unforeseen degree of slack in the labor market, as well as question the reliability of initial jobs data.
And Valeria, alongside softer payroll data, the unemployment rate in August inched up to 4.3%. That remains within what many consider a steady long-run range, yet it is the highest since November 2021.
John, while the headline rate is important, I believe we should look beyond it and consider other measures of unemployment. For example, the U6 unemployment rate, which includes marginally attached workers in the labor force, has risen more quickly than the headline rate, pointing to broader slack in the labor market.
The trends in labor force participation also show discrepancies across work groups. Despite the recent uptick in unemployment, the prime age labor force participation rate sits at 83.7%, exceeding its pre-pandemic level. This indicates that even amid signs of labor market cooling, core age labor supply remains resilient.
Well, while prime age labor force participation remains resilient, the narrative for non-prime age group is quite different. Participation among older workers has declined to 38.1%, continuing a gradual downward trend since the start of the pandemic. Meanwhile, the participation rate for 20 to 24 age group has slipped from 72.5% in March to 70.2% in August.
I agree with your point, Valeria. On top of that, the rate of hire dipped from 3.5% to 3.3% this July. With prime age LPR and long-term unemployment rising, this points to accelerated cooling in hiring. After September's FOMC meeting, the San Francisco Fed President Mayor Daly noted weaker entry-level placement and fewer junior job posting as signs of labor market slowdown. With quits and layoffs being relatively stabilized, this JOLTS data further supports the notion of labor market looseness.
Youngju, this looseness is reflected in the vacancy to unemployment ratio, which is currently 0.99. Looking backward, Blanchard noted in 2022 that vacancy peaks have historically been followed by sharp declines that outpace rises in unemployment. This has been the case for the last 8 quarters since a vacancy peak in March of 2022.
Now we'll examine more specific considerations and risks in the macroeconomy, deliberating the path of future rate decisions. I believe our policy stance should take into account the current supply and demand dynamics underpinning inflation. Currently, demand-driven inflation dominates headline PC readings, while supply-driven contributions have steadily waned.
One perspective on the inflationary impact of tariffs comes from former Governor Kugler, who argued that tariffs pose upside risks to inflation, while Cleveland Fed President Beth Hammack noted that upside pressures to inflation remain, stressing the importance of continued restrictive monetary policy to bring down inflation.
John, I tend to align more with Governor Chris Waller, who emphasized that a totality of economic factors, including tariffs and high interest rates, that could have a bigger impact on unemployment than tariffs alone would on inflation. As such, an easing bias in monetary policy is warranted, as the risk on inflation from tariffs is outweighed by the risk of an increase in unemployment from business uncertainty.
So, while demand-driven inflation remains a significant contributor, the supply-side pressure continues to play a role as well. While I appreciate Governor Kugler's perspective, it is also important to recognize broader economic factors at work, such as elevated rate, tariff, and other supply-side constraints that continues to influence the inflationary pattern. Either way, I believe labor market side of the mandate deserve our attention as well. The beverage curve appears to be shifting back towards its pre-pandemic positions as distortions such as reduced job matching efficiency and labor reallocation fade. However, post-pandemic, the curve has been focused on its steep portion.
And Yanju, as Governor Waller noted in 2022, positioning on a steeper side of the curve allowed for disinflation without a sharp rise in unemployment. Indeed, inflation has declined from record highs, while unemployment has remained stable. More recently, though, the curve has flattened and moved closer to its inflection point, reducing the scope for further disinflation without stress in the labor market.
Agreed. As Chris Foote of the Boston Fed noted, while interest rates rose amid record high job vacancies, unemployment remained relatively stable, rising less than 1 percentage point after mid-2022. As the beverage curve flattens, further drops in the vacancy rate will result in larger increases in the unemployment rate. Perhaps the Phillips curve could provide some insights into how the labor market is affecting prices. I align with Greg Mankiw's view that it is mostly a theoretical tool, though understanding its shape remains useful in assessing current conditions.
Ben, I agree most with Olivier Blanchard and Ben Bernanke, who argue that pandemic-era inflation demonstrated a linear relationship between inflation and labor market tightness. And, if anything, former Fed Chair Janet Yellen's view that the curve has become quite flat is the best characterization.
Good point, John. I tend to align with Peter Hooper and former Governor Frederick Mishkin, whose evidence for a nonlinear Phillips curve was compelling during the pandemic. However, with supply pressures now eased, it is less relevant with the current environment.
Regardless, I believe the strength of the economy posing upside risk to inflation may be a greater relative threat to the Fed than a weakening labor market. For that reason, perhaps maintaining our current policy stance may be warranted. While real private fixed investment has remained steady over the past couple of years, investment in AI and data centers through IPP and equipment have soared over the past couple of years.
That's insightful, John. Echoing that, we've seen software and hardware investments continue to rise, more than 12 and 43% respectively year over year. Cutting interest rates could potentially cause the economy to overheat, putting upwards pressure on inflation.
Well, while AI investment has clearly contributed to recent GDP growth, there remains substantial uncertainty surrounding its ultimate impacts on labor productivity, both in terms of timing and magnitude. As Richmond Fed economist Andreas Hornstein noted, no matter how many anecdotes we have about AI applications, it must show up in the aggregate data and across the broader economy before it becomes meaningful for monetary policy. For example, I think two pieces of aggregate data to observe the effects of AI would be labor force participation and job gains. Both show how structural changes in productivity and labor supply feed into the economy's long-run growth potential and therefore into the neutral rate of interest. Consequently, I believe New York Fed President John Williams' observation that the low R-star era persists remains relevant. The same demographic forces that pushed R-star down following the global financial crisis, being aging populations and slowing labor force participation, are still in place. A rate cut would help bring policy back to a more neutral stance more quickly.
I agree with you, Ben. The private job gain has slowed down drastically. Since the upside risk to inflation from tariffs remains relatively limited, the restrictive monetary policy might not be the most relevant in this scenario. We should look to return to a neutral policy stance sooner rather than later.
But that depends on what a neutral policy stance is, Youngju. Estimates of R-star vary significantly. The Holston-Laubach-Williams model estimates it at 0.84%, whereas the Laubach-Williams and New York Fed's DSG model place it as high as 2% in the near future. No matter the estimates, consensus models indicate that R-star is higher now than it was pre-pandemic. Now, time for a policy recommendation.
Well, I vote 25 basis point cut. The balance of risk is now tilting more towards unemployment compared to inflation, but the labor market still remains in balance.
I agree with the 25 basis point cut, Valeria. Although the labor market is continuing to weaken, the unemployment rate is still relatively low by historical standards, despite how the last few years may have taught us otherwise.
I think the path of rates matters more than any single decision. I'll vote in accordance with my colleagues in favor of a 25 basis point cut, using forward guidance to signal the possibility of larger cuts in the future while emphasizing our commitment to 2% inflation and our insensitivity to short-term declines in asset prices.
I also vote for a 25 basis point cut. We should continue to view maximum employment as an inclusive and broad-based goal.
I agree with the 25 basis point cut. I also believe that we should continue the pace of our balance sheet reductions, as the banking system still has ample reserves. I also believe we should stress that the path of rates is downward and remain that data dependent for each individual meeting. Thank you, and we look forward to your questions.
Thank you for your presentations and your analysis. We have seen monthly gains in jobs move sharply lower this year relative to last year's period, while at the same time, the unemployment rate has only moved up a bit. How are these observations consistent, and what are the implications for monetary policy?
That's a very interesting question that we've been considering. As you mentioned, we've seen a steep decline in job gains from now 27,000. Right now, we put the break-even level with the Dallas Fed of Tremukin in 2025 at around 30,000 jobs, which is a steep decline from 2023, which put it at 250,000 for that reason. As you mentioned, unemployment has only increased modestly in that period. We really see this as a lag between the two, and there is obviously some slack in the labor market contributing to the difference in the two metrics not correlating as much.
And as Chair Powell mentioned in the FOMC meeting, press conference, we are seeing both shift in labor market demand and supply. I'll talk about the supply first. So we are seeing reduction in the immigration, and as well as we are seeing the deduction in the labor market participation, although the participation rate for the prime age group stays resilient. And then for demand side, we're seeing some cooling demand due to the business uncertainties and other macroeconomic factors surrounding it.
It's also important to consider how models such as the beverage curve could help explain some of these measurements that you've referred to. The beverage curve shifted outward following the pandemic, indicating that bargaining power was higher among workers and peaked in 2022 with V over U at 2. Downwards, it has evidence of downward trend since then and sits at 0.99, indicating less bargaining power, which also feeds into less job switching. One reason that could be an explanation for some of the facts that you pointed to.
Lastly, another factor we must consider is that the unemployment rate, especially the U3, is often criticized as a more lagging measure as opposed to more forward-looking measures such as the beverage curve, as employees are often the last thing employers do when cutting back on the hours worked is they'll lay off employees. So the unemployment rate can often lag behind other economic indicators regarding the labor market. So it's important to take the totality of labor market factors as well as supply and demand into account when assessing the state of the labor market.
Well, thank you. And just to re-up the second part of the question, and thank you for those very helpful answers. If there is a discrepancy between the monthly job gains numbers and the unemployment rate, what are the implications for monetary policy?
I think the greatest implication for monetary policy in that case is that since monthly job gains can often be a little bit more forward-looking than the unemployment rate, it means that we need to be very watchful and have maybe a downside bias or easing bias in monetary policy to ensure that the labor market doesn't worsen further and potentially reach a recession. And in light of our dual mandate of maximum employment and stable prices, it's our job at the Fed to make sure employment is as high as possible while also keeping the price level under control. And for that reason, we need to, in those cases, be very careful that the labor market does not weaken and that we don't see the unemployment rate eventually start to go up as job gains would continue to be low.
We also think it's important to note that there's been a lot of revisions in job gains recently. And so although we may see substantial job gains in the future or maybe some downward trends recently, it's always important to stay data dependent and understand there are various trends within the labor market to pay attention to. As we referenced, the beverage curve is a great reason to believe that we can, even with lower vacancies, unemployment doesn't necessarily have to increase given the steeper trend of the beverage curve recently. And so for that reason, it's a totality of economic conditions beyond just that.
Thank you very much. We'll have a second question about financial conditions. So how should policymakers take into account signals from financial markets, such as stock valuations and credit spreads, when deciding about monetary policy? And a second question, if changes in financial markets have different implications for monetary policy and financial stability, how should policymakers weigh the trade-offs?
Well, it is important to note that while we have to monitor the financial conditions, especially the yield curve and treasury conditions at the Federal Reserve, it is our goal to achieve maximum employment and price stability of our dual mandate. And for that, we have to monitor all of the broad economic conditions, and that will affect the monetary policy.
That's a great point. When we think about economic conditions, it's no secret right now that there are very high valuations, especially with regards to technology companies and the status quo. We think that good, stable financial conditions are a byproduct of prudent monetary policy, and oftentimes balancing the dual mandate will often set expectations accordingly. With that being said, we're resilient to a short-term fall in asset prices, meaning that as long as we continue to see the hype in stock market prices continue to translate into free cash flow and ultimately revenues down the line, we continue to believe that there is still stability there.
It's also important to note the current state of financial conditions as evidenced by measures Chicago's Financial Conditions Index, and such as high yield spreads, as you alluded to, the Chicago Financial Conditions Index peaked in 2022 and has been on a downward path since, also indicating that conditions were never particularly tight this cycle. In addition to that, high yield spreads are currently within reasonable levels, indicating that there's excessive or an abundant amount of lending capacity and that borrowers are not particularly constrained. So that, in conjunction with the yield curve's reversion to an upward slope, also indicates market confidence in the Fed's inflation targeting. And there are other measures such as longer dated tip spreads, of which the August 10-year break-even was 2.3%, which all goes to show that financial conditions are not excessively tight and that the market participants are confident in our ability to command stable prices for the benefit of the American public.
As my colleagues were saying, our dual mandate regards price stability and maximum employment. But that being said, we do need to monitor financial markets for two main things. First, we need to see any factors that will affect our dual mandate. And the second thing is that we need to make sure financial markets function and that we're able to implement our monetary policy. So that dives into the Fed balance sheet. We need to make sure reserves in the financial system are at an ample level so that the federal funds rate remains within the target range and doesn't go outside the range. So it's important that we monitor the effective federal funds rate in the market and other measures of repos to make sure that we're implementing a monetary policy. And if reserves are too scarce, or too abundant, then we can therefore adjust our balance sheet to ensure reserves are in the right spot to maintain a healthy short-term lending market and effectively implement the federal funds rate. But at the same time, we don't necessarily need to have an impact on, say, the stock market or the longer-term bond market, because those aren't part of our mandate. And while we'd like them to be healthy, because that generally leads to a healthier economy, there will be sometimes market froth that isn't necessarily completely within our control that we don't need to react to.
All right, thank you very much for
Do you
these.
want to ask this?
Yeah, maybe we should make sure that you have a chance to respond to the second question. So there are different implications for monetary policy and financial stability that you noted that is both important for the mission of the Federal Reserve. How should monetary policy weigh those? I think you partially answered that you think should not, but is there a trade-off between those two?
No, we don't think there is a trade-off between those two. We think that if we can maintain, both a healthy financial system and effectively implement our policy, we can maintain our dual mandate of price stability and maximum employment, and while also keeping, financial markets healthy and functioning and able to effectively implement our policy to promote our goals.
Great, thank you.
All right, so thank you. Let me come back to one point that you raised in your presentation concerning R-star, and there was a point that I was a little bit confused about. So you titled a slide, "Dovish stance, is the low R-star era over?" Can you dig into this a little bit more? So what is the use of R-star in the policy process? What are the main determinants of R-star in the past, and how you project this into the future?
Yeah, for sure. So R-star is the neutral rate of interest, and right now it really determines what the policy stance is in terms of an accommodative or restrictive policy. And so estimates of R-star, as we mentioned, the Holston-Laubach-Williams model puts it at 0.84 as the real rate, whereas the Laubach-Williams and New York Fed's model puts it close to 2%. Recent research from Ina Hajani at the Cleveland Fed detailed that the R-star trends are often due to things like labor force participation, as well as wage growth and productivity trends. And all of those things can contribute to how it's evolving over time. Recently, we've seen a decrease in overall labor force participation, which may have lowered R-star, and wage growth deceleration may have actually increased in the short term for that very reason. And so thinking about how those trends have manifested in the short term are very, very pertinent to how we're prescribing monetary policy and whether we have an accommodative or restrictive stance in the short term.
And then I can also speak about the other determinant of the equation, which is the total factor productivity. As we mentioned in the AI slide, we are seeing technological advancement, which we expect to be having the productivity gain. Economy has been gaining productivity like throughout the history from like 1970s all the way to now. And we think this factor might vamp up our star up, but however, as my colleague Will mentioned about the labor force participation, we're seeing the aging wage labor group, which might be working on a different direction to this equation.
It's also important to note how measurements of R star have guided our recommendation today. We view that our current policy rate is still somewhat restrictive, as evidenced by the fact that two of the models we displayed have estimates of R star below the effective federal funds rate. And so the reason that we were guided to our recommendation to present to the committee today is that we, through somewhat restrictive policy, can exert pressure on inflation, which, according to the San Francisco Fed, is roughly 60% demand driven, which responds more easily to our policy. And so we can still exert pressure on inflation from a disinflationary point of view while also accommodating a slightly fraying labor market. And so we, through measurements of R star, were guided around to that recommendation.
We feel
No, please go ahead.
we feel that our star, based on our current interest rate policy, we're currently in a restrictive stance. And while our star is most likely higher than it was during the 2010s due to changes in productivity and immigration, as we said earlier, some of the trends from the previous decade, such as aging populations, are still in place. So it's important that we continue to monitor our star and assess as accurate as we can be about the current level of monetary policy, so we can make sure that we're not suppressing the labor market too much, or on the other side, allowing inflation to increase.
So just a super quick follow-up. So how does knowing the level of R star tell me whether policy is accommodative or not?
If the interest rate is above the level of R star and inflation, that means that you're being restrictive in monetary policy. So that should push down inflation, but at the same time, it should also increase unemployment. Whereas if you're below the level, R star to be the neutral rate of interest, then you would be causing, in theory, unemployment should go down, but at the same time, you're going to cause inflation to go up in a neutral stance. So if you know where it is, then you can look at where we are in the perspective of our dual mandate on the price stability side and the maximum employment side, and then balance those to get an appropriate policy stance that's either accommodative or restrictive, and by how much.
Well, as many of my FOMC colleagues have noted, monetary policy is really a risk management exercise right now. As you look at the balance of risks, how do you evaluate it? Are you more worried about upside or downside risks, and for what reason?
Yeah, of course. Thinking about the two sides of the mandate right now, it's no secret that inflation is above the 2% target at 2.7%. Meanwhile, unemployment has inched up to 4.3%. But this isn't something that the committee hasn't faced in the past. You can think back to 2004 and 2011, other periods where the dual mandate has been in conflict. And oftentimes, the lesson learned there is to decompose both of those two sectors into its requisite parts. So Atkinson of the Dallas Fed on the inflation front recently found that core goods is contributing about 0.3 to 0.4 percentage points to overall or core PCE. And we mainly see that as due to tariffs, which has historically been a transitory effect. According to research from Schmidt-Grohe and Uribe of Columbia University, around 80% of tariffs in the post-war period have been transitory. And so we can really see past those as mainly supply-driven more than anything else. But on the labor market side, we think there's more risk as the V/U ratio has declined significantly. All the while, wage growth has decelerated to its lowest in the last 12 months at 0.7%. For that exact reason, we want to believe that the labor market poses greater risk right now. And so a more accommodative policy stance could help the cooling labor market more than anything else. And so that's how we view the balance of the risk in the current moment.
So yeah, going into what my colleague was saying on the unemployment front, we're seeing some forward-looking measures such as the V/U ratio trend toward a softening labor market and indicate the labor market is in balance. And we've seen the trend of the unemployment rate going up, which is something that is very important to monitor, as well as as well as job gains go down. So that indicates to us that the labor market is weakening, while again, as Will said, we believe that inflation being above target, especially because of the core goods now providing positive pressure instead of negative pressure, is due to tariffs, which we do believe a one-time effect that we can look through and see that and expect inflation to, in the near future, return to our 2% target.
Another reason why we believe tariffs to be transitory is because of recent research from Barnachon and Singh of the San Francisco Fed, who actually argue that in the long run, tariffs can be deflationary as increased uncertainty.
Thank you.
Thank you.
Thanks for coming.
Thank you. Excellent job.